Hey everyone, in this video I wanted to bring you one growth stock that's down 38% off its high that I think it's an excellent buying opportunity on the dip here. But before I tell you what company this is, let me share with you its revenue, its cash flow, its operating profit, and its valuation so that you can understand why I like the stock so much, and then I'll let you know what the name of the company is. So let's get right into it. Starting with this company's revenue. Trailing 12-month revenue has expanded from a little less than 24 billion all the way to 41 billion, and that's after coming back down a little bit before its highs around late 2022. This company does benefit when people are buying electronics, which they were buying and in a boatload during the pandemic when we were stuck at home and going out and buying services, traveling, restaurants, and all of those things were restricted. So this company surely benefited, and that's why you see a little bit of a dip here as people now reversed and are going out, spending more money on travel, restaurants, eating out, things like that. But over the longer term, it should continue to benefit from growing purchases of electronics and growing effectiveness of electronics worldwide. The next metric I wanted to show you is this company's operating profit. I'm sorry, this is the cash flow from operations to sales over the trailing 12 months. And again, you see a bit of a dip here recently, going down from the peak of around 35% down to 21.65% most recently. This is a bit of a concern because of the downtrend. However, the actual number 21.65% is a solid number. I'm just a bit concerned about the downtrend here in terms of its cash flow from operations to sales. Now, that's not so true when we look at its operating profit margin over the trailing 12 months. In this metric, it's relatively stable after a V-shaped recovery here in the middle, but an operating profit margin in the trailing 12 months of 31% puts it in the top tier of the companies that I follow, a very strong operating profit margin indeed. Now, you might ask, what are some reasons why the operating profit margin would be excellent and the cash flow from operations would not be so good? One of the main reasons could be inventory. When a company spends money on inventory, that's a negative cash, that's a cash outflow, so that works against its cash flow from operations, and so that metric looks worse. And then when you look at the operating profit margin, it's still stable because higher inventories doesn't directly translate into lower operating profit margins unless those higher inventories eventually need to be discounted and sold at a loss, and then that'll start to bring down the operating profit margin over time, not directly, not immediately. Finally, the last reason I'll give why I think you might regret not buying this growth stock is the very respectably reasonable valuation at a forward price to earnings of 12. Given this company's excellent revenue growth and operating profit margin, I think buying it at a forward PE of 12 is a bargain. So what is the name of this company? This is Qualcomm, ticker symbol QCOM. I think this company's got solid growth prospects in the mobile business going forward. Its tech is among the leaders in the industry. There are some concerns, some competition. Apple using some of its own chips and going away from Qualcomm for some of its products. Although I think the company will overcome those risks longer term. Again, at this valuation, I like the risk versus reward long term. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.